That's a great transition to the next piece here, which is that, listen, the Fed initially, when they started hiking rates, was like, okay, maybe a quarter of a point up, maybe half a point. Oh, that's a lot. Oh, maybe 0.75 of a point, 75 basis points. Now, according to Bloomberg, the Fed could weigh a historic 100 basis point hike. That's a full percentage point after inflation scorcher. They say futures show 1 in 3 chance of a supersized July move. 75 basis points now also in play for Fed's September meeting. Let me read you a little bit of this just to hear their analysis. They have quotes here from economists who say, after what happened in June, I do not rule anything out. This is the chief economist at Amherst Pierpont Securities, whatever that is. I had been thinking that the Fed would decelerate to a 50 basis point per meeting pace beginning in September. But if the next 2 monthly inflation numbers look like May's and June's, all bets are off. So you now have analysts saying they could go as high as a full percentage point hike. This is an insane escalation, because the only thing worse than inflation is inflation that continues plus a recession. Plus, not only are you getting your wages cut effectively by inflation, but now you're actually out of a job. I mean, there are ways that this situation could get much, much, much worse. And that seems very much to be the direction that we are risking right now.
Yeah, Citibank came out with an assessment this morning. They say, quote, we now see a 100 basis policy rate increase at this month's FOMC meeting as the most likely outcome. So people at the market preparing for a 100% or 100 basis point hike. I mean, even if it's 75 basis points, 0.75%, that's a lot. I mean, I was looking right now, the average mortgage rate right now in the United States at a 30-year fix is 6.36%. That's the largest increase in the mortgage rate in a short period of time in modern American history. So, okay, we may not living yet in the 1970s, but it's beginning to rhyme a lot with the 1970s.
Yes, it is.
And everything bleeds into consumer spending. That means that businesses on a macro level cannot borrow cash at a cheap rate in order to invest in their workforce and in capital expenditure. So they're going to cut all investments, cut their workforce in order to protect the stock price, especially as consumer demand goes down. Also, on a micro level, try getting a car loan right now. Try getting a house loan right now. Try getting any basic loan, outside of the credit card system, and you are looking at a very, very high rate, which is going to constrain your behavior. So it bleeds all the way down and increases the likelihood of unemployment. And really, that's the goal. You saw Larry Summers came out yesterday. We talked about this. He's one of these people very much of this view. He said we need at least 6% unemployment right now. I mean, that's almost double the unemployment rate. That's hundreds of millions of people.
This dude had
who are going to be unemployed if that becomes the case.
He said we need 10% for a year.
Yeah, for a year.
Yeah, I mean,
or 6% for like 3 years.
Right.
This is a long time.
Actually psychopathic.
Yeah.
And the backdrop of all of this too is labor that has this historic sort of momentum behind it in terms of the grassroots organizing that's going on. You've had huge skyrocket in the number of union elections. And I'm sure you've heard all of this whining of the capital class of we can't get workers in the labor market. There's not enough people to work and we're having to give them raises and it's so terrible. They would actually love a higher unemployment rate because that imposes a sort of discipline on workers, makes it less likely that they're going to file for union elections, puts them in a position where they just have to take whatever scraps they're ultimately given. So there's an incentive here from the capital class, too, to discipline labor and hike the unemployment rate above and beyond just, we want to get inflation under control. So that's part of an important context here as well. And unfortunately, history bears out that if we go into a recession, if we have unemployment continue to spike, which the last jobs report continues to be very strong. We continue to create a lot of jobs. They're just, wages are getting cut by the cost at every single turn. But, history shows that if you do have unemployment rates spike, you're going to have many fewer union elections. You're going to have workers in a much more difficult and precarious position. So again, as bad as things are now, they can get worse. They can get a lot worse if we continue to have inflation because we're not dealing with the underlying issues. and we're in a recession, that is an utter disaster and catastrophe.
Yeah, look, the inflation is not going to be stopped by a cut in demand because only about maybe a third of it ish is demand influence. So that means 2/3 of it is going to be supply. We really could be living in. Also, the other thing is that let's say that the Fed is the only option. Well, then you actually have to basically do what Paul Volcker did in the 1970s and raise interest rates to like 25% and actually induce a massive recession with a crash consumer demand. Jerome Powell says he doesn't want to do that. So then you would have this weird world where interest rates are like 8-9%, not actually high enough to induce a full-scale recession, but also not going to deal with any of the underlying problems. And we will just, skate through this thing for years and years and years. I really do think this is going to define possibly the next 5 years to the next decade. We had a decade of easy money, and now we're probably going to have a decade of some, I think, hard times. Now, there's an argument for that from a libertarian perspective, like the best companies come out of a bootstrap. Okay, yeah, maybe, but that doesn't mean that there isn't a lot of suffering along the way.
Well, we know coming out of the last recession, what really happened is you had a massive spike in inequality. Ultimately, the response to the recession contributed to that. You had a majority of middle-class jobs that were lost during the recession. Coming out of the recession, the majority of the jobs that created were low-paid, low-wage jobs. So this hasn't worked out well for working-class people. Again, the people who have money, recession's an opportunity for them. This is the same thing we saw last time as well. They went out, they snatched up lots of single-family homes and apartment complexes. They bought all kinds of distressed assets so that when things turned around, they were in a position to massively, massively profit. So, they always win no matter the situation. And again, they would be happy to see labor disciplined a little bit and so that they can once again just call all the shots and have workers have absolutely no say in their workplace. The last thing I want to say about the Fed policy, because I think it's important to keep the global context, and this again is what happened in Sri Lanka this week. What's continuing to unfold in Sri Lanka is an important reminder of this. As we hike rates here at home, that effectively increases the cost of dollar-denominated debt around the world.
That's right.
So all of these developing world nations that borrowed heavily during the coronavirus crisis to be able to take care of their people while their economies were shut down, they're in a very precarious position now. And not only are they dealing with the knock-on effects of the war and the massive inflation increases and all of these other disruptions that are going on around the globe, but then also their debt is becoming much more expensive to service. So they are getting squeezed in a lot of ways. That's why you've seen a huge spike in the amount of distressed sovereign debt around the globe. You already see a sort of flight of investors from developing world bonds. That can also create a kind of domino effect of instability and chaos around the world that, of course, doesn't just stay in those countries.
40th order effects, there always exist.
Exactly. Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.